Hi, and welcome to another Inspiration podcast. My name is Omolola Koka, Head of Research here at Inspiration. On this episode, I speak with a diverse group of energy practitioners from multinational law firm Gowling WLG, energy and procurement experts at the Energy Consortium, UK independent power producer Conrad Energy, and Squeaky, a next-generation marketplace for buying clean power from generators. The discussion goes into the current geopolitics of energy the industry finds itself in, tackling whether the prices we see today are transitionary, and if so, how can PPAs become more innovative to make such prices sustainable and meet the ever-changing needs of both off-takers and sellers. So why don't we start off with you, James?
Great. Good morning, Omolola, and it's great to be here. By way of a quick intro, I'm an energy lawyer at Gowling WLG, and I've worked on a wide range of renewables projects over the last decade, with my practice spanning, amongst other things, PPAs, both utility and corporate, wholesale trading, regulatory advice, and energy tech, and I lead the firm's energy tech practice. I've advised on a significant proportion of GB's largest renewables PPAs, including in recent times a huge 1,075 megawatt Seagreen offshore wind farm.
Hi, good morning. I'm Chris Bowden, the founder and managing director of Squeaky. I've been in the energy markets for over 30 years now, both as an energy trader, a project finance banker, and I used to run a company called Utilix, which became the largest buyer of electricity and gas in the UK, where we also pioneered corporate PPAs back in 2008. And Squeaky is essentially a business allowing generators to sell electricity directly to end users, consumers, business consumers.
Adam?
Hey, morning, Omolola. Morning, guys. Adam Clark, recently joined Tech as managing director, joined at the beginning of March. Prior to that, I have a background in energy risk management and energy trading. Most latterly, I built the largest offtake portfolio of renewable generation in the UK at EDF before joining Tech, as I say, at the beginning of March. Nice to see you all.
And last but not least, we have Tim.
Good morning, everybody. I'm Tim Foster. I head up Conrad Energy's energy services activities. Conrad Energy are an independent power producer and energy supplier. My background has really been right the way through from energy supply through power purchase agreements and general route to market. And at Conrad, I head up those activities, so power purchase agreements, route to markets for generators and also the wider energy supply.
Okay, great. So in recording this podcast with you guys, we are now experiencing the other end of the extreme from what was really low prices in the early days of COVID-19 to now, because of the Ukraine and Russia war, extremely high prices. It's a very interesting time, but it's telling us one thing, which is interesting, that it's not isolated events. It's spilling over into different markets, affecting energy security. I was wondering if we could start off by what this means for the sustainability of the UK's energy market. Why don't we start with Chris?
I think sustainability in terms of, is the UK energy market broken? And I think you got to remember that, we live in an interconnected world. Fortunately for the UK, actually, very little of our gas comes from Russia, only about 3%, as opposed to Europe, where it's over, I think, 35%, something like that. But because our gas comes from Norway, we have quite a lot of indigenous, but a lot of our swing gas comes in the form of LNG. We are exposed, like all markets, to the international price, and we are competing for that gas on international markets. And so, that's why we're seeing these significant, and why we've seen the significant uptick in pricing and incredible volatility. I think if you go back to 2011 to 2020, the average price over that 10-year period is 45, a low of 22, and a high of 46. If you look at the average of the N2EX, we're now seeing an average in the last 3 months of a whopping £200. It's 4.5 times higher. So, we are exposed to international prices. We can't really get away from that anytime soon. We have a lot of renewables on the system, but that isn't what sets the price. And I think that's what a lot of people think about, can we shift to more renewables until we've weaned ourselves off fossil fuel? The marginal price of energy in the UK and the rest of the world will be set by fossil fuels. And so, as a market, we are linked to the rest of the world.
Okay. Thank you, Chris. And do you guys share the same thoughts?
Yeah, I was going to say, Chris, I'd agree with what you said there, and I think I don't know if you'd agree, but what's remarkable is had the Ukrainian war not taken place, I think we'd still be having this podcast talking about exceptionally high prices. I think it'd be remiss of us to say that this is all created by Putin's invasion. If we look at charts prior to the invasion and even the period before anybody really knew what was going on there.
Yeah.
We've seen prices slowly escalate over the last 18 months. And, I've heard of talk, are these the new transitionary prices? Is £100 baseload the new, is that the new normal? We know we had an exceptionally low wind year last year. We know that we had to use gas that had been intended for this winter, etc. But, is that the market we're now facing, or is that the market we're now operating in, particularly as we look to transition, as Chris says, to a greener and more renewable future?
So I completely agree with what you've both said, Chris and Adam, and particularly, Adam, the point that you've made that this is a much broader issue than what's happening right now. Last summer, we saw wholesale gas prices spike, didn't we, which led to a great number of suppliers folding and a great number of consumers there, therefore including me, going through the solar process to a new home. And that is in recognition of, as we exited the pandemic, the global demand for fossil fuels soared. And as you mentioned, we import, I think at the last count, about 30% of our energy from overseas in the form of fossil fuels. And therefore we are subject to volatile global markets. And that isn't going to change in the immediate term, as you say, Chris. Interestingly, the late 90s, early 2000s, we were a net exporter of energy, but now with increasing reliance on fossil fuels, the government has recently launched the energy strategy to go some way to addressing that in the medium and longer term, seeking to accelerate deployment of nuclear, offshore, including floating, wind, hydrogen, and solar, to help kind of insulate us to some degree from reliance on those global markets. But those impacts will be, as I say, not immediate. There will be a few years down the line till we get these projects with the associated storage capacity required, the intermittent generation online.
I think one of the things that I worry about and think about is that energy security always trumps, the carbon or green agenda. So it's going to be more important for us to think about energy security in the future. And that worries me slightly in terms of our transition, because the real transition fuel for renewables is gas. A lot of people talk about storage, but it's just way too expensive, and it will continue to be too expensive into the futures. The conflict in Ukraine is causing problems with the ability to source lithium, for example, and other rare minerals that you get from Russia. So battery storage costs are going to go up as a function of that. But as we transition to a renewables future, we will need more gas, and now we're uncertain or concerned about where that gas comes from. Remember that most of the world's gas is in places where you don't have a democratic system. The North Africa, the Middle East, Russia, these are big gas producing nations. And so, it's that this geopolitics of energy is just going to get greater and greater. And it's a concern for me in terms of the transition. What it has done is made energy prices more expensive, which means renewables are more competitive. but they take a long time to roll out and deploy.
Okay.
Maybe not as
Tim,
long as nuclear.
so Tim, you look like you wanted to jump in.
Yeah, I was going to say, I think Chris has probably absolutely hit the nail on the head there. Gas is the transitional fuel. If you look at where the gas producers are, both currently and also going forward, and cross-reference that to the Foreign Office Travel Advisory service, you'll notice that most of those actually are on that list. And I think that just gives us genuine concerns about supply going forward. And that is reflected perhaps in a risk premium in the prices we will see. I think the other thing really to note is that very high wholesale prices are good for a generation, but on the other side, somebody needs to buy that power, somebody needs to consume it. And I think that is the other issue we really do need to think about, is that an energy market where this current winter is £225 a megawatt hour power at the moment, and perhaps a long-term £100 plus a megawatt hour power price benchmark is not good for UK PLC and UK energy consumers in general. And whether or not that's a new norm or a transitional phase as we get more and more renewables online and perhaps costs come down is going to be interesting to see how that plays out in the next while. But as Chris mentioned, this is not an immediate solution. Renewables, battery storage projects, energy projects in general take a long time to come online. New nuclear that was announced in the last week is 10, 12 years plus of time. And I think we do need to think both short and longer term about how we transition and whether or not these prices are going to be here for the foreseeable future.
A really good point, Tim. Amalola, you asked, how sustainable, or is it sustainable? For energy intensive industries, it probably isn't, or it almost certainly isn't, because the ability for energy intensive industries to pass these costs through are very limited, as we know. As we all know, from April's price rise, energy prices are already a burden on households. More to come in that in October, and I don't think we've fully seen the full impact of this increase in wholesale energy prices on consumer prices more generally. So, we said right at the beginning it's a global market, but we do know there are discrepancies between pricing in those markets. And observation I'd have is that the UK, it's a liberal market, it's open, and we price it at almost at the marginal. Expect that those that have the opportunity or option to diversify where they make their goods might look to other markets. So in terms of sustainability for the UK, I suggest that these very high prices are quite a threat to UK's competitive capability.
Okay, and thanks for that, Adam. And actually, you asked an interesting question earlier, saying, are these prices transitionary? So just to put everything that we've just discussed into context in terms of how extreme the prices we're looking at, how does this compare to past trends you've seen?
I'll go first. I mean, we've never seen it. I mean, prior to this, I think all of us on the call but we'll remember 2008. That used to be our benchmark. We used to talk about 2008 and warn new recruits. This is how bad things can go. But we flew past 2008 pricing levels. You explained at the top of the call. 2020 we saw record lows, prices that we hadn't seen for a long time due to COVID. But this is unprecedented. I don't think we 2nd of March was at 800 pence gas. That we haven't seen. So this truly is exceptional trading conditions.
I might just come in there because I've got a slight advantage here that we've been doing quite a lot of research on what the impact might be on the I&C market. In my previous company, Utilix, we spent a lot of time developing the hedging strategies for large corporates, and I've written a blog about this. If you go back to 2020, the average N2X price was £35. In 21, it was 118, and in 22, it was 268. And the way that I&C customers typically buy energy is on a rolling forward hedge basis. So most of the big FTSE 100 companies that we worked would look to hedge out 18 to 24 months ahead. So they never went into a financial year with any exposure to power prices or to gas prices, because that can hit your financials. One of the biggest controllable costs you have. It can really hurt you. I think what's been happening, and I'm sure what's been happening actually, is a number of those corporates have not been following that. So so they've been running back their hedging from 24 months out to 18 months out to 12 months out to even less than that, because as the power price goes up, it becomes more difficult to buy into a rising market. And human nature is, oh, it must come back down, it must come back down. And I think we've yet to see the full impact. You've seen it on the domestic market because that's a rolling 6-month hedge. That's how the price cap works. But in the commercial market, it's usually a rolling 18 months hedge. So what we've seen in the domestic market, it's going to start hitting this year and next year, and it's going to be pretty incredible. I mean, if you use the £35 2020, that's something like £3 billion worth of wholesale electricity, for example. If you use 268, that's £23 billion worth of wholesale electricity. So think about that flowing through into the P&L or the L of several large companies out there, or medium-sized companies. It's scary.
Just to back up Chris's point out, we've seen that in action. Nobody in the energy procurement wants to go and speak to the financial director about locking in an energy price rise, and I think we've seen exactly that, where hedges have rolled 12, 18, 24, 36 months is out. Now they've now gone down to literally within year, and a number of large consumers are having to write very large energy cost into their business, which is not good. I think the other thing as well, even stepping down the level, the amount of small and medium-sized enterprises and smaller industrial and commercial consumers who tried to wait this out just to see if something gets resolved, and they've ended up having to renew or potentially go into default tariffs at the 1st of April. They are working their way through the system as well. So where they've seen energy bills at sort of delivered cost of 15 pence a kilowatt hour, previously they're now looking at 40, 45 pence a kilowatt hour, which I don't think any of them can wear in the longer term. And I think that's really, we are going to see this play out in the next 3, 6, 9 months. And either, as Chris said, it's either going to be passed through to us as consumers, ultimate consumers of goods and services, or we're going to see a spate of failures of wider companies, especially those who traditionally energy has been quite a small element of their cost base. It's now become, one of the biggest costs, if not the biggest.
I had a question. I'm going to ask, can the UK survive these prices? But I think it's pretty clear it's not sustainable, as Adam shared earlier.
It does depend, doesn't it? If everybody in the world is paying much higher energy prices, then for many companies, that's okay. Because if I'm a big manufacturer, if I'm a cement or, steel manufacturer, and all of my competitors are paying really high prices, then it's okay. It does mean that everybody else has to pay higher prices for everything, but it's a competitive thing here. So it's really about, how does our energy price compare to the rest of the world, to the rest of Europe, to our near neighbours where we're competing?
I'd agree with that, Chris. It's, I think, where there's parity in price across global markets, and then I think that plays out. I think just to build on your point, I guess what we might agree is that if this truly is the new normal, then as consumers we might expect to consume less. So the threat might not be against competition; it might just be, global demand will shift down, because simply, we will not be able to afford things we could at 40 pence a base, 40 pound base load. If cement's now being produced at 260 base load, cement is going to go up by quite an amount. So I wonder if we'll build quite so much.
With my next question then, what is the liquidity of the trading markets, and what does that mean for PPA or revenue contracts going forward? I had put Tim to jump on this.
Yeah, liquidity has always been a problem, and I think over the years, Ofgem particularly has had a number of attempts to try to address liquidity and forward liquidity. Back in the old days, Enron was around, and you could get a price out for 10 years if you really wanted to from energy prices from them. But I think the reality now is that liquidity and the number of players in that market have decreased. So we've seen the failure of a number of small energy suppliers who quite often use PPAs to hedge their own supply position. We've seen larger energy suppliers, energy traders look seriously at the credit requirements to allow them to trade. So we've seen general price liquidity dry up, particularly in seasons that are beyond the current year. And also, I think just general market volatility has made people very concerned. I mean, we've seen prices move £20 a megawatt hour per trade. You can come in the morning and energy prices are at one level, an hour later they're at £50 higher or £50 lower. And I think that from a volatility point of view, just makes it difficult to see price discovery a longer way out. What this does, of course, open up is the opportunity for consumers to replace that liquidity. So if a large energy consumer, as Chris has already mentioned, is looking to hedge power out for multiple years, then the traditional route of going through getting their price discovery through their energy supplier or energy trader could, in theory, be replaced by that price discovery by talking directly to a generator or a portfolio of generators in order to get that delinking from the wholesale traded market. And I think we're starting to see a lot more engagement in that sort of sector rather than just your over-the-desk trading type activities. That is perhaps an interesting byproduct of the current volatility and high prices.
Yeah, I just, before I go on to add to that, because I totally agree, Tim, there's a real opportunity here to create a liquid market between corporates and generators. But before that, I think it's really important to understand what's really going on in the traded market. So as an ex-electricity trader, right now I'd be very worried about my credit lines and my capital base, because if you go back to this sort of benign period of 2020 before that, you entered into £100 million 1 year electricity contract and you'd need probably 10 million collateral upfront, 10%. If you're in the current market, that £100 million trade is now 400 million. It's at least 4x. So now we've got 4 times the amount of value for the same number of megawatts. And also you've got a much higher volatility. So now I'm looking at 30% initial collateral now. So I now have to put up £120 million worth of capital, whereas I was putting up 10. So that makes trading energy, and you've seen this through the Uniper, Uniper had to borrow another 10 billion on top of the 10 billion they'd already borrowed. This is a company that has a market cap of 7 billion. So you can see how expensive it's become to trade. And that's why, the liquidity isn't there, because, traders and utilities talk about, I will warehouse that risk. I hear that a lot, sell the power to me, I'll warehouse that risk. Not anymore. You just can't afford to warehouse the risks that you used to warehouse. And so, buying 50 megawatts of summer 24 is dangerous these days. The capital requirements, the market move afterwards. And so no wonder the bid side of the curve is 20 quid less than the mid, and the offer side is 20 quid more. There's a spread sometimes of 30 or 40 quid in the market for base products, never mind complex products like peak. So, that's what Tim's talking about. If you can cross that spread and get a generator to sell to a buyer, you disintermediate this, this warehousing issue that utilities and traders have, and you also disintermediate the collateral requirements, because quite often generators and buyers can do transactions without the requirement for collateral. So massively improves the efficiency of the market if you can get buyers and generators to meet in the middle.
Thank you for that, Chris. Adam, you are shaking your head as Tim and Chris were talking.
Well, not in more than shaking, yeah. Vehemently agreeing, and I am now a buyer, and not unlike a lot of INC buyers, as Chris outlined earlier, little and often is generally the best risk approach. But liquidity is a real issue. And Chris mentioned a sort of £20-30 spread, and that's only in some markets that that quite often it's all implied price. So you try and build a strategy around implied price. You then speak to your trading outfit, and you realise that is £40 higher. You know, that's significant. That massively changes your strategy and risk appetite. So, you know, again, I've never quite known times quite as tough as this to buy and sell energy for the reasons Chris and Tim have outlined. You know, from a buyer's perspective, it's really difficult, because not only have we got to work out what's happening to LNG cargoes in the South Pacific, we now need to work about, you know, have an appreciation for capital requirements and all kinds of other things. You know, this is something that UK buyers are not used to. Typically, you ring and ask for a price, and within a 1 or 2%, or the price on the screen, you'll be offered something, you know, within 1 or 2%. That is no longer the case. It's changed 6 weeks, if not the last 6 months.
Before I move on to my more specific PPA related questions, I just wanted to see whether there is a case then for the market pushing itself towards a merchant future. Do you see this as being one of those pivotal moments, or it's not likely yet?
There's a big discussion going on amongst financiers, project financiers, banks, and investors about whether, you know, they need to fix the power price on projects anymore so they can build them and take the merchant risk, because they're taking exposure to an unknown price in the future. That's definitely a trend, because I think, you know, the cost of generation, 2 years ago, a solar project needed low 40s as generated to get the returns investors needed. Today, that's low 50s to high 50s, depending on the quality of the project. That's a 10 to 15 pound uplift versus a 150 pound uplift in the wholesale market. So that means that the appetite for merchant projects has gone up. Investors are thinking, maybe I can get £100 into the future. So definitely, yeah, more projects will get done on a merchant basis. But of course, you know, the risk there is that the prices come back down at some time in the future. So, you know, as with everything, you know, if you go merchant, you are taking a bet on the future power price.
Yeah. So then, is this where floor prices come into place?
I'll leave that to you, Tim or Adam. You know more about the classic floor PPAs.
No, I think the floor is always a difficult area. The floor is, I mean, the question is always whether or not a floor is actually worth anything. And that's been the fundamental point from, you know, over the last 10 or 15 years. And I expect, you know, back in the day, it was just a requirement of the funders, of the financiers, that did it have a floor price? Yes, tick. And the assumption was that energy prices may or may not get down to that level sporadically during the 15, 20-year PPA term. And it was a necessary safety net. I think the issue now is I mean, are floor prices necessary? I think, you know, certainly investors would probably still like to see a floor, or like to see some guarantee of income. But it's quite difficult at the moment to trade off that sort of guaranteed income at quite a low level versus that front end uplift, you know, for being either merchant or even just having a couple of years of merchant at the front of a project and then refinancing it. I suppose the other question is where is a floor price going to be pitched? Is it going to be at the long-term value of electricity? And how long is that long-term? Or do you take the new now as the indication going forward? I cannot imagine anybody writing a floor price at £100 megawatt hour. Certainly not. And whether or not you then move perhaps away from a floor price to a fixed price as that sort of structure. Personally, I think the need for floor prices, or the requirement for floor prices, maybe is not as strong as it used to be. And I think what we will see is that, you know, the element of fixed pricing or locking in revenue is probably more important than ever for a generator in order to, you know, satisfy the funders and their own returns.
I'd second that, Tim. I mean, we obviously wrote probably over 100 PPAs with floor prices in view over the years, but very much now, particularly as we're moving to, you know, we've moved past the phase where subsidies were readily available for renewables projects, and there was a real emphasis then on having that floor. I think that as the market's evolved, lenders have become more comfortable with taking the risk of not having a floor, because it was the lenders that were requiring the floor, wasn't it, back in the day rather than equity, because it would be equity that took the hit on the discount to facilitate that floor. And what we're seeing certainly now is more forward hedging in the PPA fixed prices, and fairly rarely, in fact, seeing floor prices, because as you say, what do you set the floor price at the moment in such a volatile market? The levels that we historically have seen will be completely pointless where we are today.
Tim, did you want to say something? I saw your hand.
No, I was just going to say that, I mean, the other thing that's really important is the additional revenue that comes into the project from not having a floor. I mean, typically discount levels, you may have got an extra 5% or on your revenue just for not having a floor. And I think the early days, 10 years ago, where it was a must, you had to have a floor. It was a simple structure, floor price, and then some sharing of percentage sharing against a revenue stream and index or similar, have changed. And I think as buyers become more sophisticated and there is more information around in the marketplace, you are seeing that level of sophistication come through into PPA contracts. You are seeing the ability to fix or unfix in certain cases, and roll on index and then step back in again. And I think this is where volatility and uncertainty of energy prices sort of drives that behavior, and people come up with innovative solutions. And Chris mentioned the early days of corporate PPAs. That was very much a solution to the problem at the time, and I'm seeing we're going to see increasingly sophisticated solutions to what's going on at the moment.
I'd agree with that, Tim. It used to be the reserve, didn't it, in the 2010 era? It was 6, maybe 10 large off takers and fairly standard contract. That we can't pretend to ourselves this is now a mass market area, but corporate PPAs has certainly increased the range of buyers and the shape of this market, and perhaps that's something we explore a little later. But it's moved away from a simple offtake model, quite often government backed subsidized assets where a little bit extra through the wholesale market never hurts anybody. But let's be honest with each other, the funding model was broadly based on as we move into an unsubsidized world, we're now facing into a different buying brief, perhaps. Perhaps sometimes, as Chris alluded to, with the supplier as the intermediary, but the range and sophistication, ironically, given that we're bringing this to the masses, is increasing. So the range of structures, I dare say, will increase a number of times, particularly as the number of buyers and their requirements change.
Thanks, Adam. You guys have actually naturally touched on my next question, which was going to be on the evolution of PPA structures, like the need for more sophistication. So actually, I'm thinking, is there a challenge then of these PPA structures and different products maybe coming out? Is it a matter of them keeping up to pace with the changing market?
So I pitched a PPA, corporate PPA in 2005 to a supermarket, and we did our first deal with Sainsbury's in 2008. So this is not a new product. I have to say, though, that it has not moved on very much. And when we launched Squeaky in 2017 with a focus on selling platforms for generators to sell power directly to consumers, and one of the reasons we did that is the market had not moved on, and we wanted to try and innovate. And I think, unfortunately, the utility sector is not very innovative. It's very inward looking, and so they don't think about customer needs, whether it be generators or consumers, as much as they should do, and create products that deal with those risks. So had it not been for COVID, I think we would have done a lot more of the consortia deal we did with the Energy Consortium. The first, I think, European first on a real consortia deal where a group of buyers, some of them very small, came together to sign up to a single corporate PPA, all on standard terms, all signing the same document. I remember a lawyer, that there was 22 lawyers involved in the transaction, and one of them I met at a Garling's event, and he said, one of the refreshing things about this transaction is when we said we want to change the paperwork, we want to change the documentation, we said no. No, we've been through this 1,000 times. We've done 1,000 corporate PPAs. It's a fair document. You have to sign it as is. And actually that's refreshing to get people to say no, and actually people go, okay, fine. But there really does need to be a lot more innovation, and certainly Squeaky, I think, is at the forefront of that. You know, we're doing more consortium deals at the moment where we're doing our first 5-year deal. We're working on our first 5-year deal. I can see corporate PPAs effectively becoming an alternative trading mechanism for generators, 1 year, 2 year, 3 year, cutting out the middleman of the utilities, and then restructuring of the arrangement. So every PPA, whether it's a utility or corporate PPA, has to deal with the same set of risks, right? So if we look at the market risks, it's balancing risk, it's capture risk, and it's price risk. And the easy one, the one that everybody understands is price risk. You know, is it a good value against the market? So as generated, it's 55, it's 50. And people will argue a lot about that pricing, but I think we'll see a lot more innovation around managing and dealing with these other risks, which are really significant now. So balancing risk, you know, I think Tim will probably know that better than me. Some of the best best utility PPAs were struck at something like 85% of the N2EX. You know, that was, you know, amazing days. And the best ones from a generator perspective are probably in at 98%. And Adam probably attest to that as well. I think those are around the sort of ranges of prices you see. And that's where somebody's taking the balancing risk. Now that's gone back down now. I think you're more likely at 93. And so balancing risk is 7%, but it's 7% of £100 now, or 7% of £200 in this current market. So that's a big value. We need to think about how that's addressed in a PPA, corporate PPA. And then this other thing, capture risk. Well, not many people really understand capture risk. Yeah, it's a complicated thing, but it's huge. It's a very significant risk that needs also to be managed in this construct of a PPA. And so I think we're going to see product development around that, because capture risk is now forecast to be for wind and solar around 20% of the price. So if your base load price is forecast to be 100, then you're going to, you know, capture 80% of that. So you're going to get 80 quid a megawatt as a wind or solar project. These are just rough numbers. And so, you know, arguing about £1 or £2 on the as generated price and not thinking about these other risks and how you deal with them in an effective and efficient way, I think that's where a lot of the innovation, certainly where we're working on, you know, products to innovate around managing those risks. That's where we see a lot of opportunity.
Right. Thanks, Chris. I just wanted to go to you, James, since Chris name dropped Gowling and your event, but also from a contract perspective, is this something where you're seeing managing the expectations from, I guess, clients who could be either corporates or generators? Is this something where it's a not constant back and forth, but it is this push to get a wider understanding of the needs and the risks of the projects, but also to get to a point where it's balanced between both players?
And I think that there are a variety of forms of PPA out there, some more established than others. For example, utilities all have fairly set forms, which generators, investors, lenders are all relatively comfortable with. What we have seen in recent times is the increasing prevalence of corporate PPAs with a wide array of corporate purchasers from various sectors that have their own form of documentation, which is perhaps not driven by GB Energy, you know, track records and PPAs. They're based on, for example, a US energy supply PPA contracts that they will use globally, and that reflects that, you know, that we have a large range of corporate buyers from outside the mainstay to date, and that has led, you know, Tim and I were chatting before, this has led to many to ask, well, can we have some form of standardization in the corporate PPA and indeed the utility PPA space? And I guess very much like we have with electricity trading, we have the well-established GTMA. Gas, we have the MBP, we don't really have anything for PPAs. EFET has produced a document which isn't widely used. We've got, I guess the closest thing we've got in GB is a backstop PPA, which is a fairly good PPA, but again, isn't widely used. And it needs the industry really to come together if that's going to happen, and to fire some trade association or central body which corporate buyers collectively tap into, contribute to, and commit to use, because we are seeing at the moment an increasing array of forms of PPA. So I think that would actually be very beneficial for both generators, corporate purchasers, lenders, investors, all stakeholders in the market.
Thanks. Adam?
Yeah, James, really well said. And yes, please. I've so far been I've written a good few corporate PPAs, and the only thing that's probably consistent with all of them was at the end we promised to make the next one that bit easier. And I'm not sure we always learnt our lessons. I think that there has to be an opportunity for all of us to come together and just share our thinking on this. We do talk about net zero. We need to work more collaboratively together. And for me, this is one area, because they're complicated structures, huge sums of money is involved, etc., etc. I know that, but there has to be scope for simplifying and increasing the ability for those who perhaps don't have the resources to participate in this market. This is a market that probably needs to grow. There's certainly a demand from consuming customers to participate, but one huge barrier at the moment is the level of sophistication, the time and resource required in order to undertake a corporate PPA. Typically, on the core, 9 months, for a new to earth asset, that is a significant investment for somebody whose energy is a relatively small part of their overall spend, but an incredibly important part of their spend, because they're busily trying to, decarbonize their scope 1s and 2s, for example. So any opportunity to get together as an industry to simplify this area, I think I'd certainly be very much in favour of.
Yeah, if I just come in there with a point, I suppose, thinking back over the years of doing sort of long-term PPAs, there's probably 90% of a PPA contract is generally untouched per transaction. It's probably, if you looked at them, they're word for word verbatim, probably the same. And I think that's it's always been a problem of whether or not there is just time spent just negotiating PPAs for negotiating's sake. And I think that's always my point, as somebody generally who fits some of the bills in that process. You always question that from the lawyers' notes there. But I think it's interesting going forward. With corporate PPAs and the wider sector, you're dealing with a section of the energy industry that is not energy savvy. And there is a fair bit of education involved in that process. And there's also then going back through and having to explain, maybe the fundamentals of PPA contracting, which at its heart is just a sell and a buy of energy in its sort of DNA. I think the issues generally come around, and I can see the argument for standardization for a fair bit, but then you move into, how do you cover off capture risk that is changing the capture price? How do you cover off imbalance risk, which changes? How do you cover off the non-delivery or the non-consuming risk as well? And this is where you're involved into these sort of quite difficult discussions with generators or consumers. A generator is always optimistic the site will start on the 1st of April. And that's assuming it would build out during the winter if it's a solar site. Or the consumer says, well, I'm going to be consuming power for the next 20 years, but then production is then moved to a different country. And I think this is where, when we talk about any PPA, this is the sort of risks where you do end up in the bespoke territory. So I think there's a scope for getting a lot of it correct and standardized. There's always going to be, especially for big consumers, for multinational consumers, there is always going to be this element of a bespoke negotiation around their own particular requirements. I think that standardization could be applied if you start thinking a bit about buying groups or wider, smaller consumers, where perhaps bundling together, whether there is some aggregation of risk. and potentially aggregation of generation on the other side as well. So you can see an argument where by mitigating some of the risk by aggregation, you could reduce those legal costs down, and you could start to look at proper standardization across the whole PPA contract.
Yeah, I think one of our vision of maybe how it could be standardized is to rethink the whole construct and to say a number of things have to happen here, a number of risks have to be taken. And, from my sort of securitization days many years ago, we used to think about this and say, well, okay, where should we put these risks? Who's best able to take these risks? Who wants these risks and who doesn't want these risks? And so to think about reconstructing the corporate PPA framework, we look at it as a framework and say, okay, where can we place these risks in the most efficient way? And that's where you'll get standardization by breaking it up and standardizing its component parts. I think that's where we see the future. But the only issue with that is we're trying to standardize something that is complex. There are a lot of advisors and lawyers who don't honestly understand some of the risks that we're having to deconstruct and place into the market. And so, very recently on a transaction, we had a bank that said, no, I only want to do it. I only want to do the lending if the deal looks like this. And we said, well, actually, it does look like this. It's just constructed differently, but you end up with the same same revenue profile. But actually, because it was square in a round hole, they didn't want to do it. And so that you can innovate, but if the advisors and the lawyers and the banks don't want to, use anything different or new, which is our industry, frankly, I heard about it. That's what I hear about innovating in this industry. It takes so much time because the powers that be, you're trying to innovate from the inside. The utilities don't want to change that fast, and so, but we need this innovation. We need these new products to increase the number of buyers in the market. So the tech deal had 22 universities coming together to do a deal, right? That's incredible, right? People say, where's all the liquidity coming from? It's not going to come from the big tech companies anymore because they're full. They're getting full of power. We've got to get it into smaller buyers. We've got to get, we talk about standardization, simplifying, shortening and shrinking these arrangements so that we can get more buyers in. That's what's got to happen. But if the banks and the investors and the utilities go, oh no, it's not the same as we've seen before, then we'll struggle.
I just wanted to pick up on that as well. Obviously, tech, the energy consortia, to your point, there are certainly advantages to a generator in dealing with a consortium of buyers. At the negotiation stage, perhaps there are a few more lawyers involved, but I think over the term of the contract, that socialization of risk, that socialization of benefit, I think does bring significant benefit to the generator party, in as much as you rightfully say, at the very simplest level, the portfolio benefit, differing consumption patterns, for example. Not all universities are the same. I'm sure you guys know that already. But by mixing the consortium up, particularly with typically they're all very well credit rated anyway. It does provide for an attractive proposition for generators, I would say, and certainly as a buying group. My belief is that it does offer something quite unique to a generator who may diversify their risk, or at least limit their risk on such a long-term frame.
Chris, Tim, you guys touched on, I guess, the wider market opportunity to bundle consumers together. And I imagine that means there's going to be a greater role for aggregators in the market. How do you see this coming about to transition us into the outlook?
So we're working on 3 consortia deals at the moment, and it's interesting, they're all different. One of them is an industry group. So they represent a specific industry in the UK, and they want to buy together because they collectively want to reduce their carbon emissions. And so that buying group wants to come together to do corporate PPAs, but they're all supplied by different suppliers. So there's a set of challenges that we have to deal with. But it's interesting that these groups are coming together around a common sector and wanting to work together. Another group is a group that is represented by a single buying collaborative, and so they're different companies that are coming together and they're wanting to do a deal, and individually they're too small, and so they're coming together for the aggregation size and benefit. And the one I'm most excited about is a supply chain. So very large company wants to push clean energy into their supply chain. The companies themselves are too small to do a corporate PPA, and so what the main, the company that they supply is saying, okay, we will organize this transaction with Squeaky, we will pull it together, and you can call off a certain amount of megawatts, and it can be like 0.1 megawatt. It doesn't have to be a 5 megawatt deal or one megawatt deal. You can be at a very small amount, and we'll build up until we get to a certain amount, and we'll anchor that deal. And so they can anchor the deal, they can do all the negotiation, they have the skills and the knowledge to do that, and then they can bring their supply chain into that corporate PPA. And I think those are sorts of things we're seeing in the market, which will hopefully increase the number of participants and the amount of energy that can be bought through corporate PPAs.
Really like that, Chris. The notion of those that can help in those that perhaps can't just now, because as we said a moment ago, this is a complicated area and there's a level of sophistication. So where there's common interest, decarbonisation, energy procurement at an appropriate price, then it makes good sense, doesn't it, for those that can to support those that at the moment can't. It's there's probably a role for us to play as at the larger end of the market to support those who have as much energy and desire to decarbonise as the rest of us, but unfortunately don't have the resources.
I think it's interesting. You're also seeing that on with oversizing behind the meter scheme. So similar to your analogy there, Chris, you've got a consumer who is anchoring the project behind the meter. So maybe a large solar or a D plant feeding into a site, but then oversizing that project to allow export out to either the wider group of the consumer, if it's a site within a group, but also, again, I've seen a lot of interest with the supply chain, particularly where they're being forced by who they're selling to actually green their whole process up and decarbonize, and by themselves they are individually incapable of doing that, just can't afford it, or just are not the size where equipment suppliers or energy engaged to actually offer those services to them. So it's interesting to see that even with physical assets behind a meter, and maybe making 20-30% bigger than the site consumed just to get that. It's interesting. I mean, from an energy company as well, it helps mitigate the risk. I think, Chris, as you mentioned, and Adam has mentioned, you've got different shapes and different shapes of offtake, different types of consumption, different shapes of generation, different locations as well. There is a lot of natural mitigation that comes to help reduce some of these risks if you are putting different types of consumer, different types of generator together, and it helps manage the residual shape risk from an energy supply point of view as well.
Just to kind of continue from what you were saying, Tim, is there a role then for storage in this aid to mitigating the risk in this transition we're seeing with prices?
Yes, I think there's a simple one-word answer to that. Yes. Yeah, the UK is just so short of storage, of any energy storage, be it long or short term. And we're seeing growth in that. But as has already been highlighted on the call, you just simply cannot press a button and everything magically turns up. And I think we really are seeing the need for both short and longer term energy storage requirements. National Grid managing the system at the moment, if it's a windy day or a wind drops off, you suddenly see big requirements of storage. We'll see yet more of it during the summer as we have either very sunny days or forecast sunny days and the sun doesn't turn up. But you'll see that sort of natural within day use of storage to consume or re-export energy, but also to manage the frequency of the grid. I think there's a fundamental problem as well, which is, how do you get to the point where you actually have longer term storage? If you're talking about solar overproduction, during the high summer or high production times of the summer, you're talking about 6 to 8 hours of large amounts of generation. We've seen a huge amount of sites with big DNO curtailment requirements on at the moment, why while they're waiting for either reinforcement or just simply as part of their dynamic grid connection. And it always frustrates me that, you know, we should be producing as much energy as we can. It's just a use of natural resources. And we really do need to look at how we utilize or store that energy, be it in batteries, longer term storage systems, changing behavior, changing customer behavior. Do we go back to economy 7 type electrical heating of the domestic market, for example, which took advantage of overnight low energy costs 30 years ago? Do we move back to that sort of stage, maybe with a bit more, with more clever solutions to that? But yes, is the easy answer to that one.
I guess one of the upsides, if there are any of these incredibly high power prices, Tim, is that all of these things are back on the table. I don't think they've ever left the table, but there was never really that financial imperative to look at these things. Perhaps this would challenge us, because you mentioned about innovation across utility, but more broadly, does this encourage the innovators out there to come up with a technology? Because we've always said, as part of the net zero journey, haven't we? We don't know what technology is going to deliver it. We only know what we can see in front of us. What we also know is that will not deliver net zero. So perhaps if we're looking for a silver lining, perhaps these inflated prices encourages innovation and will bring new technologies to market that will help us to achieve true decarbonisation.
I agree with what you both just said, Tim and Adam. And as we move to an ever increasing low carbon generation mix and intermittency forming a large part of that, due to the fact we're an island and we can harness the wind resource very effectively, we're going to need to put even greater focus on storage, both short and long term. I guess by long duration energy storage, typically mean over 4 hours, don't we? But weeks and months even. And the type of technology is not just battery chemistries, but liquid air, compressed air, thermal, gravity-based systems, all that kind of stuff, which is is in its infancy in deployment, but is a great hope for enabling a low carbon net zero future. And I think that I saw a report by McKinsey, perhaps at the tail end of last year, saying that the most cost-effective route to net zero is going to be harnessing long duration energy storage. So not only is it a cost-effective path to net zero, but it seems essential given the generation mix that we're aspiring to in light of the government strategy announced just a short while ago.
We've learned, haven't we, as humans? It's like we waste a lot less during periods of crisis. So if this is a crisis, are we learning now not to waste energy, and are we learning to harness the energy available to us? Quite, even my next door neighbours put a washing line up. They've always used a tumble dryer, but these energy prices, they after 5 years have finally succumbed to a washing line. So if it's hitting Middle Britain, then perhaps it is starting to have an effect.
Thanks, guys. We have to come to the end of this. There's so much to talk about, and I'm sure that much more could be said. But I'd just like to get your closing comments regarding what we all just discussed. But also, I'll be cheeky and squeeze in a question. Do you think the current market conditions are negative or positive for the energy transition?
Shall I go first? So,
yeah.
Look, in the immediate term, clearly it's a threat. If this is a blip, we need to be able to ride it. So, we need to be able to make sure that businesses can survive these current energy prices. On a more positive note, it's getting a lot of attention. This now is not the preserve of sustainability and energy buyers or estate managers only. FDs, CEOs, etc., are now very bought into this. So perhaps there is a unique opportunity, and I don't know how long it will last, where actually decarbonising is a cheaper option. Hitherto, it's always been, how much of a premium are you willing to pay to decarbonise? Against the backdrop of a very illiquid market, we've talked about that, but against the backdrop of a hyperinflated market, opportunities to look at alternative sources of energy from alternative markets, I would argue, is positive. And so there is a mood swing amongst energy buyers to look more favourably at low carbon sources of energy, not least because economically it makes sense.
Thanks, Adam. Anyone else want to jump in? James?
I think that, I'd agree with that, Adam. It's in the moment, it's not comfortable for consumers, purchasers of electricity. Nobody wants to pay higher prices, but what it has done is put a sharp laser-like focus onto this issue, which was already, picking up steam gradually. And then we had, COP26 last year. We feel that we've got a real momentum behind. And if we can take a positive from this acute spike in wholesale prices, it's that we are going to be powering through the energy transition at a greater speed than we otherwise would have been. Would we have seen the government's energy strategy published last week had we not been in such a volatile market, or would it have included the steps that it did? I don't know. So the hope, of course, is that for the short-term pain economically, there'll be long-term gain on that energy transition to net zero, but also in the hope that whilst gas will be a transitional fuel, the reliance upon overseas imports will go down from the current high levels and offer greater insulation on pricing, in addition to the low carbon nature of the power that we're generating and consuming.
I'm probably just going to add exactly the same message again. I don't think a 3 to 4 fold increase in energy prices is good for anybody. And certainly the speed at which that has come, given where prices have been perhaps on the longer term, has obviously come as a complete shock. What it does do is really does incentivize that innovation in technology, in data and data management and information, which we need to drive that transitional piece. So it should increase the focus and increase the drive towards transition toward a low carbon economy. I think what it also brings up is where in the past a lot of this has been sort of one-to-one type of transactions, where you have a generator who writes a PPA is written between that and the utility, or a large single corporate consumer. What it is going to bring around is how do you address that sort of the multitude of smaller consumers and smaller generators, potentially not just your gigawatt of offshore wind, but maybe a couple of tens of megawatts or 5 megawatts of indigenous solar, and really bring those, the solutions to those. So how do you get everybody comfortable with the risk, the management of that power, and how do you give businesses and domestic consumers alike the ability to actually know what energy prices are going to be like going forward? Because with consistency, you can actually plan longer term.
Can I just add as well? I think what this is doing is it's accelerating behavioural change, because the bit that we've always struggled with, isn't it? In even at a domestic level, or I'd say especially at a domestic level, these last 6 months have had a greater impact on energy efficiency, I would argue, got nothing to back this up, than the rolling out of smart meters, because all of a sudden, it was a little bit of an inconvenience. The wastage cost you a little bit more, but it was inconsequential. It is consequential now. We're driving our cars less because we can't afford to fill the tank up. As I said, my next door neighbours now using a washing line as opposed to, people are genuinely considering, do they need all of their outdoor garden lighting? Got to say, it was a waste of energy. It is a waste of energy. People are switching those types of things off. So perhaps one positive to come out of this is that it's encouraging all of us as end consumers to consider that wastage. Again, because we can't afford to waste it currently. Hopefully, some of this will stick. So if we do see a return to new normal, we do learn to behave slightly differently and waste the energy we have a little less.
Thanks for that, Adam. And I guess Chris, to help close us out.
Yeah, look, we live in an interconnected world. One of my first economic principles I learned was comparative advantage. And that's driven globalization. So we import our energy like many countries, and so we have we are interconnected. But what I think this situation in Ukraine has done is really woken people up to the cost of energy security. And I think it's going to be there for a while now. It's not going away. people will want to wean themselves off fossil fuels, but it's, right now it's going to hamper efforts towards this net zero target that we've got, because unfortunately, energy security will always trump carbon neutrality. So, we've got to take action to mitigate risk, posed by importing fossil fuels, posed by the climate effect of fossil fuels. So we need, I think we might, from a security perspective, need more indigenous energy. Hopefully that's going to be more renewables, consume less energy efficiency. That was a big miss from the government, I think, in the paper. We're going to need a lot more grid connectivity. So it's quite a monumental shift. It's going to be very expensive, but I think this might be a trigger for us to do more to speed up that process, to speed up the energy transition.
Thank you for tuning into this episode. We'll be back soon with another episode, but until then, please feel free to like and share this one. You're also welcome to listen to our past episodes on the Inspiration platform or any other podcast platform of your choice, including Spotify, Apple Podcasts, and more. If you're interested in joining us as a guest, then please email podcasts@inspiration.com. Until next time, bye.